As you all know, this channel is all about simplifying complexities in forex trading. What we're about to look at today is called order block, and this is an imperative topic because it will increase your profitability in forex trading, whether as an advanced trader or as a beginner. Please listen carefully as we look into this very important topic. Order block. Order block refers to the specific price areas where large market participants such as institutional traders, banks and hedge funds have previously placed significant buy or sell orders. Clusters of orders are present in these areas, which can have an impact on price movement, liquidity and market sentiment. There are important areas when you open the forex chart. These areas are areas that determine the direction of the market, and these areas are areas of interest to institutional traders. Who are these institutional traders? The institutional traders are big players. They are the big boys in the forex market. They have the deep pocket, they have the funds. You as a retail trader do not have the huge fund they have. So when they step into the market, they usually create impulsive moves. They usually create aggressive move, either making the market coming bearish, that's going down, or they make the market to go up bullish. When they come in, because they are coming in with their large fund, they can decide the direction of the market. Now, these big traders, they are fond of spotting some areas in the forex chart, and these areas are usually areas where there are clusters of orders, where there are piled orders just waiting to trigger. Those orders are just waiting for a trigger, and those triggers can only be caused by these institutional traders. So this tells you that these institutional traders, they are very calculative in their moves. They are decisive, they are intentional, and very strategic. You as a retail trader, what are you supposed to do? You're supposed to trade with the mindset of the institutional traders. Look out also for the same area of interest and place your orders as they do, so that you can make massive profit, because they are making massive move, so they make massive profit. You too, you come in with the same mindset and with the same strategy, you can make what? Massive profits. Now, remember, like I said, when they come in, they could push the market downward, meaning bearish, or they can push it upward, meaning what? Bullish. Now, this is a bullish move. You can see when the market was coming down on what we have here in our chart. You can see a red candle. All of a sudden, there was an impulsive move that turned around the market from the bearish move to become bullish. This shows you that there is a footprint of what? Of institutional traders. So these areas like this are very important areas. Okay, so this is a clear example of a what? Of a bullish order block, where they came in, where the institutional trader came in and reversed the direction of the market. They are the major determinant of the market. They control the sentiment of the market, they control the liquidity of the market, they control the direction of the market. So let's watch out for their footprints. Watch out for the footprints, because these areas historically are areas that have tendency of repeating themselves. So this is also a bearish order. In the bearish order, the market was going bullish. All of a sudden, there was a big candlestick. Now, there is a candlestick prior or preceding this particular big move. That candlestick preceding this particular big move is actually where the order block is. You can see. So it is very calculated. It is not just a colossal movement. It is not just anyhow movement. The movement is actually well calculated. Now you can see then the market begin to push downward. This is very, very important. So in this video, we are looking at this concept so that we will understand how we can trade like them. From experience, we realize that these order blocks are key identifiers of key levels. These order blocks help us to identify key levels of support and resistance. They can act as turning points, like I said, influencing the future direction of the market based on the behavior of what? Institutional traders. The behavior of the institutional traders tells you where their area of interest is. These key areas are then used as an entry or exit point for trades. So the institutional trader look at where this order block are formed in either support and resistance zone. When they see the other blocks are formed in this support and resistance zone and they are being clustered, others are being there, then that is when they now make this impulsive and massive move. They trigger this move. So you need to be very sensitive. You as a retail trader, how do you then identify this order block zone, which are the areas of interest to the institutional traders? Now, there are 5 ways that you can identify these order block zones so that you can make clear and precise decision when it comes to entry or exit. Number 1 is, first, you need to study the historical price chart. When you open your forex chart, please look at the historical price chart. Look at those areas where there have been some reactions. Look at those areas where there have been some changes, where there were some impulsive moves. Mark out those areas, because there is tendency that when markets get to that same area, there will be a move. There will be a massive move, an impulsive move. So put that in the back of your mind. Doing that, you need to go back to either D1 or weekly time frame. D1 means daily time frame. You need to check from the daily time frame to the weekly or weekly time frame, or probably the 4 hours time frame, whatever trader that you are. So it's important because the bigger picture of the market is being seen from the bigger time frame. When you see those moves in bigger time frame, you cannot come down to the lower time frame for you to make your entries, either at 5 minutes or 15 minutes time frame, whatever trader that you are. But please look at the big picture from the bigger time frame. Look at the historical chart pattern, those areas where there have been reactions. That's number 1. Number 2, pay attention to significant reactions, like I say, and consolidations and breakouts. Mark those areas as strong areas of what? Support and resistance. I think I don't need to re-emphasize on that. When you look at the historical pattern, look at those places where there have been moves, where there have been reaction, there have been consolidation, there have been breakouts at either the support zone or the resistance zone. Mark out those areas, because market has tendency of repeating the same move when it gets to that particular area. Number 3 things to note is also observe price behavior through what? Candlesticks, wicks, and shadows. When price gets to those areas of high support and resistance where the order blocks are, there is always a rejection. The area is being tested. We test those areas are tested through a rejection candle. A rejection candle simply means that wick that you are seeing, the shadow. Okay, when that shadow or the wick of the candle means it's testing that area, testing if it can penetrate the area or it can't. So you have to watch out for that, those rejections. Number 4, you need to identify these institutional footprints. You will see footprints of large volumes of trade being carried out, meaning you see footprints where you see big candlesticks. Mark those areas, not those areas. Those are areas of interest. Number 5, you can make use of some technical indicators on your trading view, e.g. volume indicator, fair value gap order block, fair value gap imbalances zones, and ICT implied fair value gap. Whatever indicator you want to use, you can take this indicator. They will help you to mark out those areas, those techniques, so that when market get to those areas, you begin to notice the reaction. So these indicators are going to help you. Very, very important. Okay, now remember also there are some other blocks that are invalid, and there are some that are what? Valid. So you need to understand the ones that are valid, and you need to understand the ones that are not valid. Now, there are some factors that determine the validity of another block. Number one factor, like I said, is characterized by either a takeout, liquidity sweep, inefficiency and imbalances, and unmitigated areas. Now we are going to be looking at this gradually. You get to understand them pictorially, because if you don't see it in picture, you may not really understand it. So I'll show you how this is applicable in picture. Now, first, takeout and liquidity sweep. What is takeout and liquidity sweep? A valid order block often features a takeout and liquidity sweep. This means the price moves beyond a previous high or low to grab liquidity, showing strong institutional interest. For instance, if a bullish order block forms at the price dip below a previous low and then reverses, it engages what? Big players are stepping in, making the order block solid. Now we'll look at it. This is an example. This is an example of what we are just talking about now, taking out the sweep. Now you can look at this diagram, just look at it. You will see the difference between the valid and invalid. You can see that wick. That wick means it's taking out the sweep, taking out the liquidity area, because market is always tending towards where there is liquidity and where there is what? Where there is imbalances. It takes out from places of what? Of liquidity, so that it can fill out the gap. Now the market pull out down here, took the liquidity here. That's why you see take out. Then begin to look for the what? The gap. You can see there is a gap between this red, the last red candle here, and the other bigger candle. You understand the gap when we look at the other example. You understand that gap, okay? You will see that the market took from this liquidity sweep and tried to cover up that particular gap. You will understand that gap when we look at the next example. Now, our next example is area of what? Inefficiency and imbalance. Now, when spotting valid order blocks, look for inefficiencies and imbalances in the market. These occur during sudden strong price movement that leave gaps or areas with little trade activity. These are the gaps. Such imbalances signal aggressive buying or selling by big players, because the market is always tending toward where there is liquidity. Liquidity is actually where you see those rejection candles. It will take from that area to what? To fill up the gaps or the inefficiencies. In trading, these imbalances are often referred to price gaps, and they can serve as the indicators of where future order or blocks may form. Now look at this. I told you that when we get to the gap, you understand. Now you can see the order block here. The market took the sweep from where this order block, where you see that rejection here, and start moving up just to cover the gap. You can see the gap is covering the gap. This makes it what? A valid order block. But if you look at the other one that is invalid, the gap has already been covered with the rejection candle, with the wick already. So it is not a valid order block. A valid order block will always have this gap in between the candles that actually cause the impulsive move. Remember, I told you that the order block is actually the candlestick that is formed before the impulsive move. Now, this is the candlestick before the impulsive move. Remember, before the impulsive move moves, there is always a gap to be covered. Now, if you look at this clearly, you clearly understood that there is always a gap. So the market came down, took funds, because the funds, the money is always at the liquidity area. Picks the money from the liquidity area to cover up this particular gap, making it a valid order block. So, number 3, unmitigated areas. What are unmitigated areas? The unmitigated areas are areas that have been retested. So it means price hasn't returned to retest or fill it since it formed. So price must actually retest those areas. When the price revisits this unmitigated block, it reacts strongly because of the remaining institutional orders. There must be some element of rejection in this unmitigated. Unmitigated means areas that have not been attended to, or areas that have been tested but need to be retested. So this unmitigated nature makes the order block a powerful tool in predicting market reversal or continuation, as it indicates that there is still unmet demand or supply at that level. Understanding how to identify a valid order block often hinges on recognizing this unmitigated zone. Now this is how to identify the unmitigated zone. As you can see very clearly, you can see when the market took out this, it tried to cover up those gaps to mitigate those areas. So it is very, very important that you understand this, how to identify this order block. I'm going to be opening a chart and I will show you clearly how you can actually understand this clearly. Now this is Euro USD. Okay, now in the Euro USD, because of we don't have much time, we are going to just using this for the purpose of lecture or the purpose of learning. I have identified the order blocks already. Now look at this area. Look at this area where I use this arrow. You can see I label it as order block at the top. You can see this area clearly. You can see this area. Can you see this area? Yes. Before this impulsive move. Now this candle, this green candle with this other candle that precede the impulsive move, and the one after it, there is always a gap. Can you see the gap between this candle and this one here, this other green here? So that gap need to be covered up. It is very, very important. So the market will always tend toward liquidity so that it can what? It can cover this particular gap. So now this is what the market has done. So watch what will happen. Historically, this is what happened previously. When market get to this particular same area that I marked here, I've marked that zone, you will see that there's always what? A reaction. Now the market has not gotten to that area, but once it get to that area, it will actually have a reaction. Now come down to this particular area. Let's try and see order block. I want to identify another area of order block so that you can understand what we are trying to do here. Okay, it's carefully just follow me. Okay. Now look at this area, this zone. There's another block here. Yes, there's another block here. See the other block, and there is a gap. Do you notice that when the market got to this same area at this point, there was actually a reaction? Did you see? There was a rejection candle there. You see this? It tested that area before it started coming down. This is very, very important. It is also very clear in this area, this zone, to where I wrote this PA and this PA. You can see when market got to this area, what did market do? Historically, it came there. It has to come down to come and take the sweep here. This rejection area is a sweep. That's why the market came down. It didn't pick from here. It came down here to clear the sweep before it started moving up. So it's very, very important to see that there's always what? A reaction. Now the market has not gotten to that area, but once it get to that area, it will actually have a reaction. Now come down to this particular area. Let's try and see order block. I want to identify another area of order block so that you can understand what we are trying to do here. Okay, it's carefully just follow me. Okay. Now look at this area, this zone. There's another block here. Yes, there's another block here. See the other block, and there is a gap. Do you notice that when the market got to this same area at this point, there was actually a reaction? Did you see? There was a rejection candle there. You see this? It tested that area before it started coming down. This is very, very important. It is also very clear in this area, this zone, to where I wrote this PA and this PA. You can see when market got to this area, what did market do? Historically, it came there. It has to come down to come and take the sweep here. This rejection area is a sweep. That's why the market came down. It didn't pick from here. It came down here to clear the sweep before you start moving up. So it's very, very important. You can also look at this thing clearly from actually also 4 hours time frame. You can see that from 4 hours time frame too. You can see some moves and some rejections too. Can you see this gap too here? Can you see this gap? Can you see? Can you see this gap too? There's a gap here. Can you see this other block too here? Can you see? So this is very, very simple. You can, like I said, if you really need to understand this thing clearly, you can actually also make use of those technical tools to get to understand this clearly. So without much ado, I have tried to explain to you how to identify this order block. How to identify what? Order block. I've explained to you clearly how you can understand the order block concept. Okay, so it is important that you understand that. So lastly, in summary, while you are doing this order block, please watch out for areas where price have reversed sharply. Indicating those strong buying or selling interests. So you need to watch out for those areas where price have shown reversal, sharp reverse, indicating strong buying or selling orders. So a valid order block is often found at this key area of support and resistance level and is marked by consolidation before a strong price move. Consolidation means piling up. They are piling up. They are just resting in place, waiting to be triggered. It should also align with the overall market trend or a clear reversal pattern. So always understand that there is a market trend. I have made a video about how to understand market trend. You can check my video, you see it. And also I've also made video where you can understand chart patterns also. You see the reverse when there are reversal chart patterns. You understand all that. So please take hold of this technique. It's a very powerful technique, okay? Because it helps you to trade with the mindset of the institutional traders, and you can increase your profitability with this order block techniques. Lastly, this is just the first series. In the second series, we shall be looking at the fair value gap in details. Those gap and imbalances and insufficiencies. We will see how is relating with this order block. So thank you guys. I still remain your boy David Capital.